Well, I hope everybody is doing well. I figured I'd just hop on here, do a quick live stream, and I know we haven't done one in a little while, so hopefully we can get something productive out of here. A few things I want to open up with is obviously just a horrible day for a few companies, CVS being one of them. So we're going to talk through the quarterly reports, kind of review the numbers, and just be transparent and as honest as we can be. If you caught my last video, you guys know it's basically in my buy zone right now, even though I reached on the stock. I was looking at it at right around $57, $58 a share, and it's basically in the wheelhouse now. Want to go over the pros and cons and also talk a little bit about Starbucks and maybe some other opportunities that are out in the market. So if you're new to the channel, welcome in, consider subscribing, and appreciate it if you can smash that thumbs up. So when we go to the promotional piece that was laid out for CVS, I'm going to talk through kind of what's going on here. When we compare what they are doing versus what they've done, you know, obviously the thing you want to highlight is the revenue growth is still there, so that's good to see from prior year. Adjusted operating income coming down pretty substantially, basically GAAP EPS getting slashed in half, and adjusted earnings per share getting almost slashed in half, and then cash flow from operations pretty much getting slashed in half, which deservingly so. The stock was down 20%. Now this stock does trade for a discount compared to their peers, basically consistently trading at 10 times earnings, you know, versus their peers trading at 20, 22 times earnings. So it's trading at roughly a 30 to 40% discount, and then you add in a fall off like it had today of negative 18% at one point in time. So when we take it over to the actual hard numbers, we're going to talk through what I'm seeing here. So right off the bat, once again, the highlight is obviously going to be the revenue growth, but where I want to kind of point in and where I see the biggest problem being, and we have to figure out, is this a long-term problem or is this, you know, an opportunity, is going to be, let me zoom in on this, is going to be the $7.4 billion increment cost into healthcare costs. So this is a huge problem, and if we look at this, they would have, if they could have just kept cost at 3 or 4 billion more, it would have brought down to operating income. They would have smashed operating income. So when I look at this, that's a huge opportunity and or could be a problem depending on where healthcare costs go. But when we think about the big thing that a lot of the healthcare providers are talking about is that there's incremental cost being that everybody's going getting healthy again, everybody's going to get to the doctors, and that's driving up the costs. But when we look at the actual business model, if this can get cut down a little bit, what I like that I'm seeing here is the growth on the premiums. So kind of where the opportunity is that premiums are coming in a lot higher. Products were down, but we know the consumer is tightening up here, and Starbucks was a good signal that something's going on with the consumer. But this just goes to show how powerful this business model is, because when you look at total revenue coming down from a product standpoint, but then where do they make it up? They make it up on the premium side of the business. Then you bring it down to total revenue actually increased year over year, but when we take the expenses, this is where the big problem's lying. So prior year, they did $3.446 billion in operating income, and they're only doing $2.2 billion of operating income right now. And so where that problem lies is going to be the incremental costs that are picking up here. And so that's kind of the opportunity and or problem that I see with CVS. So the company we're talking about is CVS. And yeah, that's kind of the gist on that. So take it with what you want. You know, adjusted EPS, they are saying are going to come in at least. Let me see here. at least $7 a share, which means that it's trading on an adjusted basis for less than 10 times earnings, which I guess is historically normal for this. But when you look at how much revenue and the opportunity that this company has, I just think it's just too cheap, and maybe it's for a reason. But next we'll go into Starbucks really quick. So Starbucks overall, pretty hard to. This is where we're going to have to adjust for Starbucks here. So when we look at revenues coming in, total revenues coming in a little bit light here, that becomes a big problem when you factor in the multiple that this stock is trading for. And then so let's plug in these numbers and get an idea here. So earnings are coming down, revenues are coming down, and it's not a good recipe for when you're paying for a higher multiple on a stock. So I'm using 9% growth rates. I believe this was for Starbucks. That's CVS. So let's pull up Starbucks really quick. I believe I was using 9% growth rates for Starbucks. But if we lower these growth rates down, it's going to adjust pricing. And I think it's pretty clear that we have to lower the growth rates, at least for the near term flat. Where is it? I know it's on here somewhere. There it is. Okay. So we got Starbucks pulled up right now. And so all I'm going to do is just adjust growth rates here really quick. So if I adjust growth rates for the next few years to only going to 4%, so we get a pretty substantial hit on Starbucks if they don't regain their growth rates here. We get an ideal price target in 2032 at 161, but we're looking at closer to a $60 stock. If you're able to get it in the $60 range, $60 to $65, this is where I really think the sweet spot and the possible compounder is for Starbucks. So, and I do think you're building in enough protection to where if the growth rates drastically slow, you should be fine with this company. So this is kind of where we're drawing the line for Starbucks, just because it's just clear to see that we're seeing a deceleration in growth. So we can't put that extreme multiple on it, and we have to adjust for our growth rates, right? So when we look at that, earnings are definitely getting impacted because net attributable earnings dropped substantially here, going from 908 million to 772. And when you bring it down to an EPS standpoint, doing 79 cents versus 68 cents is a pretty substantial miss on a company that's supposed to be beating and raising pretty consistently for the type of multiple that we're paying for it. But it's definitely in an interesting point now after the sell-off that I think you have to start looking at it as a possible buying opportunity. Ideally, like I said, I think below 70 makes more sense, but maybe it doesn't get there. It depends on what you think is going to happen here. So I don't think this is one you need to rush to because it's pretty clear that the consumer is slowing down. We're getting hints of that all across the board. And then it comes down to at what price point does it make sense for you to take on risk? And when you de-risk the stock and lower the growth rate, it seems like right around that $60 to $65 mark makes a lot of sense, which means about another 10 to 12% downside would make sense for this one to be a buying opportunity. I could make an argument that if you think growth rates are going to change, then it's probably a buy right now. But if you think growth rates are going to stay flat and moderately excel maybe in the next 4 to 5 years, then you probably want to wait out for that $60 to $65. But the next one that I'm actually starting to look at here is because of Domino's coming in so strong in that shift in the consumer, I'm actually starting to look at Papa John's Pizza, oddly enough. Reason being is when we look at kind of the 5-year chart on it, the 5-year chart is obviously pretty ugly here. You're basically looking at flat returns over the last 5 years, with that big spike up during COVID of going over $121 a share, now back down to $60 a share, basically a 50% retracement. It does pay a 3% dividend. And when we look at why I'm interested in it, they're supposedly building out 50 new locations, which obviously will be a tailwind. And if we think about the consumer really shifting here, I think we're going to see them using the ordering out apps a lot less and actually going direct to restaurants where you're not paying that premium for delivery fees. And so when I look at that, that's why I think Domino's is doing well. And the other thing is like, how many areas can you spend $20 or $30 and feed family of 2 or 3, or maybe even 4? And pizza's kind of the way to do that. And right now it's kind of Domino's game, but it doesn't mean that other players can't kind of get an overspill of success from it, right? And so I look at this one as being pretty interesting because when we go over the last couple of years, it's traded for an enterprise value of $3.18 billion. It's currently trading at $2.9 billion. But when we look at forward PEs, historically, basically in line. But when we look at the finances and understanding that they're going to be pushing out another 50 locations, this is a company that was doing $1.8 billion in revenue, now doing $2.13 billion in revenue. It's not tremendous growth, but if we think that the consumer is shifting and we're going to see people now staying at home, possibly ordering out more, does this one become a little bit more interesting with basically a $3.1 billion enterprise value? I do think it makes sense, and this is a company that does have free cash flow as well. So when we look at the free cash flow of the company doing $116 billion of free cash flow, call it between 50 to 110, 120 billion of free cash flow. This seems reasonably priced with a possible economic backdrop that can suit this company fairly well. Now, I'm not saying this is a screaming buy. It's a low cap. It's going to be volatile. But I do think that it's an interesting setup when we look at kind of what Domino's has done. If you take a look at the Domino's chart, I mean, it's just lower left to upper right in just a nice steady incline. And when you look at the valuation trading at 34 times earnings, you look at Papa John's Pizza, as we said, lower cap company, free cash flowing. Just an interesting setup, I think, if the consumer is really shifting and they're looking more for that value type food. Obviously McDonald's is not handling the pricing as well, but it looks like Domino's, and I do think that Papa John's could be an interesting play longer term, considering the 50% retracement from the stock. So wanted to hop on here, kind of just go over the opportunity that I think, CVS has, the opportunity I think Starbucks has. Depending on what your mindset is, I think you can make an argument that, Starbucks overall could be a buy right now if you think growth rates can sustain or reaccelerate. If you think growth rates are going to slow to possibly be flat, then I do think you want to wait for low 60s opportunity for Starbucks. It really just comes out to how you're kind of painting that broad picture. And then when we look at CVS, there's just no way around it. It's coming down to management, and it's the cost that we're seeing here. The medical cost being an incremental cost of $7.4 billion is a substantial amount of money for this company. And when we look at if they could have just did 3.5 or even $4 billion incremental cost on the company, it would have been a really, really good quarter for them. So I don't know. This is a tough one. Am I just drawn to it because of the valuation? I don't know. I think there's so many levers you can pull with this company. It's kind of hard not to get excited, especially now that it's finally hitting my price range and I've kind of reached on it. So, but anyway, doesn't look like anybody's really on here. So I guess I'll sign off here. Hopefully everybody's doing well. Let me know in the comments if you have any stocks that you're looking at or want me to take a look at and you think has some good value or some growth opportunities. Always appreciate it. And as always, guys, we'll see you in the next one.